PepsiCo just reported earnings for Q1 of 2025, so let's take a look at the numbers and see if this company will be a good investment to add to our portfolios. Now, if you've never heard of PepsiCo, obviously I'm sure you've drank their drink, which is Pepsi, and they also own a bunch of other products such as the one listed below. So you can see thousands of choices, billions of smile. I love that slogan. But they own Pepsi, Lay's, Mountain Dew, Quaker Oats, Gatorade, and so many others. I mean, and actually you learn something new every day. I didn't know that they own this Starbucks thing right here. So I mean, yeah, there are so many that is easier to just type in here the brand you want to search for and see if they have it, but you get the point. Now here are their earnings. They were estimated to do $1.50 earnings per share and $17.76 billion in revenue. They reported $1.48 in EPS, in earnings per share, so they lost about 1.8% there in growth. However, they did have more revenue, 17.92 billion, so this means that the earnings surprise was a negative 1.3%. Usually in a normal market, when a company reports numbers like this, it's not terrible to be honest, but usually the stock tends to drop a little bit more. But what we've been seeing, especially with Tesla yesterday, they reported terrible numbers and the stock price went up. I don't know how that works, but I mean, it is what it is. This is just the market that we're in now. So let's go ahead and take a look at the numbers even further and see what we think about the stock and see its intrinsic value. Now, out of a rating of 5, Wall Street analysts currently have PepsiCo at 3.30. This is a total of 23 analysts with 3 strong buys, 3 buys, 16 holds, 0 sells, and 1 strong sell. This isn't the intrinsic value we're going to be taking a look at, but this is the price target analysts have for this company. They have a low of 124, which we're already there, and an average of $160. Keep in mind, this isn't really a growth stock. This is more of a dividend paying stock, and a stock that's, I guess you could say, quote unquote recession proof. Anything that happens in the market, this stock will most likely survive it, and they won't cut their dividend. As you can see here, they've been paying their dividend for 52 years in a row. Think about how many things this company survives, right? It survived Rona, 2008, I don't know how many wars. So, I mean, if you want to invest in a dividend paying company, this would be one of them. Again, I'm not a financial advisor. This is why we're taking a look at this company because I'm planning to add it to my portfolio. They have a 5-year growth rate of 7.25, a payout ratio of only 65, which is amazing for a company that's been paying dividends for 52 years. Their dividend yield is 3.81. That means basically per share that you own, you're going to get $5.42 a year in dividend. Let's see how this company is expected to grow throughout 2025 and starting 2026. As you can see, Q1 of 2025, it was negative, but they are expected to keep growing after Q2, Q3, and Q4 of 2025. As always, guys, we want the EPS to be increasing year over year from 2025 to 2026. That's going to be the case. And same thing for the revenue. We want this to be increasing, which will be the case from December 2025 to December 2026. Now, let's take a look at the last 5 years of the stock's EPS compared to the stock price compared to the PE ratio and see if we're getting this stock at a good price or if we're overpaying for it. Keep in mind the current stock price is $142. So if we go back to, for example, levels of let's see here, I guess, yeah, 2021, the end of 2021, the P ratio was 28. Their earnings per share was only $5.49, and the price of the stock at the time was $157, right? So fast forward to today, the latest data we have, which should be here that we just saw it, but that's Q1. P ratio of 21, which means it was less than what it was in 2021. EPS of 6.95, basically 7, which is a lot more than it was in 2021. And the stock price, as we just saw now, is about $142, which is lower than what it was in 2021. At the moment, we're getting the stock at a lower price with a lower PE, so that means we're paying less for the stock, and we're getting a company that's increasing their EPS year over year. And I mean, if we take a look at the overall history of the chart compared to the EPS, we haven't seen this PE ratio numbers since 2016. So think about it. You're buying a company, a great company, I believe, at prices that people were buying it at in 2016. And when I say prices, I don't mean just the stock price, but the EPS compared to the stock price. Let's take a look at the company's discounted cash flow and see what we would be paying for this company. The base case is that the company is worth $163.58. The best case is worth $228, and the worst case is worth $128, which means you would be buying the company at the moment overvalued by 10%. Now, as you saw, all the brands that they own, they still have more assets than liability, which is very good, especially with a company that pays such a high dividend. They have a gross margin of 55%, which is amazing. That means they have, at least is one of the ways you can calculate a moat. This is a huge company. Their free cash flow margin is it's not terrible. It could be better, but keep in mind they do a lot of acquisitions, right? They buy a lot of companies, so they do use a lot of this free cash. But at the end of the day, it's gonna be cash that's reinvested back in the company, which is gonna make it more cash. And the return on invested capital is over 10%. I usually like this to be over 15, over 20, but 18% is very good. Now, let's go ahead and take a look at the intrinsic value and see if this would be a good opportunity to buy the stock. If you take a look at the original Graham formula and you buy the stock right now at the current price of 142, you have about 6% upside in the case that is worth 150. On the other two formulas, which is the updated Graham and the analyst revised, it is currently not a buy. But for me, I think this stock is still not a buy, especially with how the market has been. I like to buy my stocks with a margin of safety of at least 35%. That means with the current growth rate projection, the EPS that it has, I'd be buying this company at a price of around $87. I don't think this company is ever going to be back below 100. I mean, something terrible in the world has to happen for that to be the case. So I think if this company drops to the 120s, maybe the 115s, I'm willing to buy it. And if it does keep dropping more to my buy price with a margin of safety, I'll just cost average down and buy more shares at a lower price. If you enjoyed the video, please consider leaving a like. Don't forget to subscribe. And as always, I'll see you on the next video.